Welcome back to the Deep Dive, the place where we skip the noise and go straight to the knowledge, ensuring you are thoroughly informed without feeling overwhelmed.
Today we are undertaking a massive structural analysis of one of the largest infrastructure players in the United States, Crown Castle Inc., or CCI. This is a company currently executing a strategic pivot so deep, so costly, that it fundamentally changes its identity for the first time in decades.
That's absolutely right. We're tracking a dramatic corporate surgery here. CCI is shedding decades of structural complexity and, frankly, sacrificing a pretty substantial dividend payment to achieve what management hopes is a higher pure-play valuation.
Right. They're trying to become the only publicly listed pure-play U.S. tower operator.
Our mission today is to cut through the press releases and, the accounting jargon. We need to evaluate whether the potential long-term benefits of this streamlined, focused strategy justify the tremendous short-term financial costs and the serious execution risks currently hanging over the company.
The stakes are massive.
And to set the stage for this deep dive, let's establish the central defining conflict that underwrites the Crown Castle investment case right now.
The conflict is defined by the massive, high-stakes gamble they're taking. CCI is betting its $8.5 billion divestiture of its fiber segment and the subsequent transition to the only publicly listed pure-play U.S. tower model will successfully drive superior value and long-term predictable growth.
Okay, that's the bull case.
Exactly. But this bullish conviction is proceeding despite the immediate, painful financial fallout, which includes booking a stunning $1.3 billion cumulative loss on disposal related to the fiber business, and facing the daunting challenge of refinancing risk on $6 billion of debt, all while attempting to meet an aggressive 6 to 6.5 times leverage target. They are walking a very high, very thin tightrope.
That is quite the opening thesis.
Right.
A $1.3 billion recognized loss combined with an $8.5 billion sale means we have to start by looking at the battlefield scars left by this pivot. Let's dive into the Q3 2025 financial snapshot.
Let's do it.
How did the performance of the continuing operations, the core tower business, look as this painful shift was underway?
Well, Q3 2025 numbers were definitely messy. They reflect both the ongoing operational complexity of the legacy model and some specific historical headwinds.
So down across the board.
For the most part, yeah. Overall, revenues and adjusted EBITDA were down year over year. Site rental revenues hit $1.02 billion in Q3, which was down a pretty significant 5% year over year.
And EBITDA.
Adjusted EBITDA reached $718 million, which was down 8% year over year.
Wait a minute. A 5% drop in site rental revenue for a company whose main asset is supposed to be this, recession-resistant, predictable infrastructure toll booth? That is a massive red flag on the surface.
It is. It absolutely is.
What drove that decline specifically?
That's where you have to look past the top-line number and really understand the source materials breakdown. This decline was not organic weakness caused by carriers stopping their spending. It was the planned fallout from a 2020 carrier merger that finally hit the books.
You mean the T-Mobile Sprint deal?
Exactly. The primary driver of that revenue decrease was Hightowers non-renewals resulting from the Sprint cancellations.
That merger, which feels like ancient history at this point, is still causing $51 million worth of pain in a single quarter.
Precisely. That single factor alone accounted for a $51 million negative impact on Q3 2025 revenue.
Wow.
Yeah. And when analysts stripped that $51 million out, they calculated the company's underlying operational growth, they call the organic contribution, was actually quite strong, which we can get into later. But for Q3, yes, the numbers were temporarily depressed by that Sprint merger hangover and by the complexities of carrying the now discontinued fiber division's operational costs before the sale finalized.
But the true price of this pivot wasn't just operational, was it? It was a profound financial trauma delivered directly to the balance sheet through these massive accounting write-downs.
That's the real story here.
So let's detail the charges associated with classifying the fiber business as discontinued operations.
We need to dedicate some time to this because it reveals how deeply the legacy strategy was, frankly, financially flawed. When they classified the entire fiber segment, which includes the small cells and fiber solutions, as held for sale, accounting rules required them to test the assets for impairment,
And they failed.
They failed spectacularly.
So walk us through the $4.95 billion charge. What exactly is a goodwill impairment in this context?
Okay, so goodwill arises when a company purchases another asset or business for more than the fair value of its identifiable assets. In CCI's case, the nearly $5 billion in goodwill associated with the fiber reporting unit represented the premium CCI had paid over the years for their various fiber acquisitions.
So it's basically the hope value.
It's essentially the expectation that this fiber portfolio would generate massive future synergies and cash flow that justified that huge price tag.
So when they realized they couldn't sell that asset for the value they carried it for, they had to legally admit that the premium they paid, that goodwill, was worthless.
Exactly. The impairment charge is the formal admission that the projected value and synergy of the fiber segment failed to materialize. That $4.95 billion charge is a massive non-cash accounting hit, but it is a concrete realization of past overvaluation.
So it doesn't hit the cash flow directly.
No, but it decimates the stated net book value and the company's equity.
And beyond the goodwill impairment, they quantify the actual projected loss on the sale itself, the $1.3 billion cumulative loss from disposal. How is that figure different?
That $1.3 billion represents the projected excess of the fiber segment's total carrying value. What it was formally valued at on the balance sheet after that goodwill hit over the eventual $8.5 billion purchase price minus the costs to sell.
Okay, break that down for me.
Think of it this way. If you bought a classic car for $100,000, but you only kept it on your books for $80,000, and then you sold it for $70,000, you have to recognize a $10,000 loss from the disposal.
I see. So the $4.95 billion was erasing the premium they paid, and the $1.3 billion was the final realization that the asset's residual value was still lower than they calculated its true cost to be.
That's it. It shows that even stripping away the goodwill, they sold the fiber segment at a loss relative to its cost basis.
It's a painful admission.
It is. Over the first 9 months of 2025, CCI had to record that $1.3 billion cumulative loss. It is a profound, permanent loss that quantifies the failure of the previous strategy to generate sufficient returns on that capital investment.
Now let's turn to the most tangible, most painful consequence for shareholders, the dividend shock. This cut was immediate and absolutely devastating for income investors who saw CCI as a rock-solid REIT.
It was a defining moment for the company's new structure. The annualized dividend was slashed by a staggering 32%.
32%.
Dropping to a new annualized rate of $4.25 per share. When you hold a REIT for yield and the yield is suddenly cut by a third, that fundamentally changes your investment thesis.
Why was such a drastic cut unavoidable? I mean, even considering the $8.5 billion in cash infusion coming soon, why couldn't they just bridge the gap?
It all comes down to sustainability and really corporate necessity. Prior to this decision, CCI was operating with an unsustainably high payout ratio. It was often hovering around 88% of their distributable cash flow.
So they were paying out nearly everything they earned.
Pretty much. And the fiber segment, despite being lower margin, more capital intensive, was crucial for sustaining that payout.
Right, because it provided that steady, reliable cash flow, even if it wasn't a huge grower.
Precisely. The fiber segment was a core financial pillar supporting that old, inflated dividend level. When you remove that massive, stable cash flow stream via the sale, the high payout ratio instantly becomes untenable for the remaining tower business alone.
So the move was necessary to align the company's dividend policy with the new, leaner asset base, making the payment defensible long-term.
That's the management rationale. The new dividend policy is designed to reset the payout to a much safer, more sustainable range, 75 to 80% of adjusted funds from operations, or AFFO.
And that's the industry standard.
It is, yeah. That 75 to 80% range is not arbitrary. It is widely considered the industry standard and best practice for tower REITs. It makes the dividend much more predictable and safer moving forward. It's a move from high-risk, high-yield to sustainable, predictable dividend growth.
This shift, though costly and painful, fundamentally defined Crown Castle's new corporate identity. So let's discuss this strategic transformation and the highly anticipated pure-play vision that management's pursuing.
The vision is simplicity through elimination. The headline move is the $8.5 billion divestiture of the entire fiber segment, meaning the small cells and fiber solutions, to be sold to EQT and Zayo.
And when does that close?
That transaction is scheduled to close in the first half of 2026, marking the official end of the legacy multi-asset strategy.
And once that transaction is complete, what remains of Crown Castle? What are you, as an investor, left holding?
The result is CCI becoming the only publicly listed pure-play U.S. power company. They are stripping everything away to focus solely on maximizing the value and cash flow generated from their approximately 40,000 macro towers.
So they're betting everything on the durability of that one single asset class in the U.S. market.
Everything.
This aggressive move is aimed at resolving the conglomerate discount, a term investors frequently use when a company owns disparate assets. Was the old multi-segment structure truly penalizing CCI's valuation that significantly?
Oh, absolutely. It was the core problem that institutional investors had with the old model. Towers and fiber are valued using fundamentally different metrics.
Walk me through that.
Sure. Towers trade on high AFO multiples, which reflects their defensive, predictable long-term contracts and low-maintenance capex. Fiber and small cells, however, are far more capital hungry. They require constant build-out capex and usually trade on lower EBITDA or DCF multiples because of that operational complexity.
So when analysts looked at CCI, they couldn't just apply the high tower multiple across the board. They had to sort of average the two valuations, which inevitably dragged down the overall price.
Exactly. The previous structure suffered from what management accurately called dyssynergies and significant complexity. By mixing these high-margin, stable macro towers with the more capital-intensive, lower multiple fiber segment, investors consistently applied a conglomerate discount to the stock price.
So the goal now is to undiscount the macro tower asset and trade in line with or even above peers like American Tower and SBAC.
That is the whole ballgame.
This simplification also came with a change in leadership.
It did. Christian Hillebrandt stepped in as the new CEO on September 15th, 2025. His pedigree is pretty perfect for this transition. He's run Vantage Towers in Europe, held executive roles at T-Mobile, at Ericsson.
So he knows the customer side and the operator side.
Right. And his mandate is not strategy development. The strategy is set. It is laser-focused purely on flawless execution and delivery of the simplified tower-only model.
Let's track the capital allocation mandate for the $8.5 billion in proceeds. This tells us everything about management's priorities, right?
It really does. It's fixing the balance sheet first, then rewarding shareholders.
So priority number one.
Priority one is stability. Of the $8.5 billion in sale proceeds, a massive $6 billion is mandated specifically and immediately for debt paydown. This is critical for maintaining their investment-grade credit rating, which is vital for tower companies that rely on cheap debt for scale.
And what about the remaining balance? That's still a lot of cash.
It is. The remaining capital, combined with other projected cash flows, is allocated to fund an anticipated $3 billion share repurchase program.
A buyback.
A big one. It's slated to begin once the sale officially closes in the first half of 2026. And this buyback is designed to be highly accretive, immediately boosting the remaining company's AFFO per share.
And the debt reduction is all aimed at hitting that very aggressive balance sheet target. A leverage ratio of 6 to 6.5 times net debt to adjusted EBITDA. Why is that specific target so crucial?
It's crucial because it addresses the core weakness we identified in the bear case, that looming debt maturity wall. They are using the sale proceeds not just to simplify the business model, but to reset the entire financial foundation before they have to renegotiate vast amounts of existing debt.
So it's about getting ahead of the problem.
Exactly. Hitting that target leverage ratio is key to minimizing refinancing risk and securing the most favorable rates when that debt matures.
The financial reset makes sense, but the long-term investment case only works if the core business, those 40,000 macro towers, is fundamentally durable and poised for years of predictable growth.
Of course.
So what is the foundation of this pure play investment thesis?
The foundation is geographic dominance within a perpetual growth sector. CCI's assets are located in the U.S. market, which has arguably the highest data demand and the most resilient carrier spending in the world. They are the toll booth on the world's most valuable information superhighway.
Let's detail the secular growth engine that underwrites this tower demand for the next decade. We often hear about the end of 5G buildouts, but the data seems to suggest the opposite.
The drivers are explosive and interconnected. First, you just have the raw data explosion itself. I mean, U.S. wireless data usage surpassed 100 trillion megabytes in 2023.
100 trillion. It's hard to even get your head around a number like that.
It is, and this unrelenting growth driven by everything from streaming to gaming to background processes requires continuous, nonstop network upgrades and densification.
And second, let's tackle that 5G cycle confusion. Why is the 5G deployment cycle proving to be far more complex and enduring than its predecessors?
Because 5G is not a monolithic technology, it's a combination of technologies. The 4G cycle was mainly focused on one spectrum band. The 5G cycle is an ongoing, multi-layered densification effort that combines low-band, mid-band like C-band and high-band, or millimeter wave spectrum layers.
So it's not a single event.
Not at all. Carriers are still in the multi-year process of fully deploying C-band, and they haven't even begun the heavy lifting of true millimeter wave densification. That requires far more small cells and, crucially, far more macro towers to hold the necessary equipment.
So it's not a single deployment, but a phased structural overhaul of the entire network.
Exactly. Industry projections now suggest this 5G cycle will easily last 10 to 12 years or more, which is significantly longer than the 4G cycle. This is the structural tailwind for CCI, because densification making the network thicker and faster requires placing more radio equipment and more antennas on more cell sites overall.
And we are seeing that strength reflected in the operational numbers despite the Q3 noise from Sprint, right?
That's the crucial counterpoint to the Q3 headline numbers. Despite the Sprint cancellations hurting the top line, the underlying leasing activity is robust. CCI was able to raise its full-year organic contribution guidance to 4.7%.
And that's the clean number.
That's the clean baseline growth rate when you exclude Sprint. That 4.7% rate is the engine management is counting on for the newly focused company.
Beyond just leasing, let's discuss a fascinating long-term strategy. Strengthening the competitive moat by increasing capital expenditures on buying out ground leases. Why is this such a crucial defensive play?
This is a classic example of smart, defensive, long-term infrastructure thinking. Tower companies often lease the land beneath their structures, right?
Yeah.
And those ground leases come with contracts that allow for rent escalations, which can sometimes be aggressive and often compress long-term operating margins. They introduce cost uncertainty decades down the road.
So instead of dealing with that uncertainty, they are spending discretionary capex now to secure permanent ownership.
Exactly. CCI is increasing its discretionary capex specifically for the purchases of land interests under its towers. They've allocated $50 million in capex to this effort so far this year.
Smart defensive play.
It really is. By buying the land outright, they eliminate future ground rent increases and lock in their cost structures, which stabilizes long-term cash flows and margins. This non-growth capex is a vital part of the new management's long-term execution mandate to create the most defensible, lowest-cost tower operator possible.
Let's look further out at the technological upside. We know about 5G, but how does the growing prevalence of artificial intelligence fit into the tower demand picture? Most AI processing still happens in giant data centers.
For now, yes. But the long-term catalyst lies in the shift toward edge computing. Current AI is centralized, but the future of AI demand will transition to decentralized, real-time interaction at the edge of the network.
So like AI agents on our phones.
Imagine pervasive AI agents constantly working for you in the background, managing your calendar, running complex searches, interacting through new form factors like smart glasses or autonomous vehicles.
That sounds like continuous low latency, real-time demand everywhere.
Precisely. That kind of instant responsiveness requires two things: high network reliability and ultra-low latency. You can't wait for a signal to bounce from your phone to a central server 1,000 miles away and back.
Right.
A dense terrestrial tower network is uniquely suited to provide this localized, high-capacity connection. AI won't just increase the volume of data, it will fundamentally change the nature of mobile data demand, requiring constant capacity expansion on towers. This is a massive, long-term tailwind.
That brings us squarely to competitive threats and market stability. Whenever we talk about infrastructure, the question of LEO satellite Starlink, in particular, always comes up. Are they a genuine threat to CCI's core macro tower model, or is this concern overblown?
Management and industry experts are highly dismissive of LEO satellites being an existential threat, particularly in the urban and suburban markets where CCI makes its money.
So they see it as a complement, not a replacement.
A definite complement, but absolutely not a replacement for the core macro tower model.
Why such high confidence? What stops a fully realized Starlink network from eventually displacing the need for terrestrial towers.
The barriers are rooted deeply in physics and the economics of capacity. Terrestrial networks deliver data throughput that is, and this is a direct quote, several orders of magnitude higher than what satellites can achieve.
So it's just a raw power issue.
It's an insurmountable capacity challenge for LEO in dense urban areas. Satellites simply cannot deliver data in scale to millions of users concentrated in a small area. The limited beam width and the rapid movement of the satellites mean they just can't service the intense density required in major cities.
And we can't forget performance issues, like latency, which is so crucial for 5G and those future AI applications we were talking about.
Correct. Satellites cannot provide the necessary ultra-low latency required for real-time, demanding urban applications. And, maybe most importantly, satellites require line of sight. Most mobile data consumption occurs indoors, where signal penetration for satellite communications is unreliable or non-existent.
A very good point.
Macro towers provide that ubiquitous, stable coverage necessary for a primary mobile network.
So if they aren't a threat, where do LEO satellites fit into the ecosystem?
They serve a vital, synergistic niche. Satellites are an incredibly effective complement for necessary backhaul support in remote or rural areas where laying fiber is physically or economically impossible. They extend the reach of the macro network, allowing carriers to serve isolated populations without massive capital investment.
So they fill gaps. They do not replace the core.
That's the perfect way to put it.
Okay, let's shift from technological threats to the financial stability of CCI's largest customers. The entire business relies on the capital spending patterns of its three largest tenants, Verizon, AT&T, and T-Mobile. Are carriers currently opening their wallets, or are they tightening their belts?
Carrier CapEx is generally turning the corner. Spending hit a fevered pitch in 2022 after the initial mid-band, C-band spectrum spending. Remember, those auctions saw tens of billions spent.
Right.
That spending slowed for a year or two, but analysts believe the trough is past and a rebound is underway now, driven by specific, unavoidable deployment goals.
What specific projects are driving this anticipated rebound, which directly translates into leasing demand for CCI?
Two major things. First, AT&T is executing major Open RAN swap-outs. They are replacing older Nokia gear with Ericsson equipment across their network.
Which means?
It means crews are actively climbing towers, installing new hardware, which generates recurring revenue for CCI through new loading and modification agreements. This is mandated CapEx for them.
Okay, and the second driver?
Second, Verizon's expansion is massive, focused heavily on fixed wireless access, or FWA. Analysts predict Verizon will increase its fixed wireless goals to 7 or 8 million customers, up aggressively from prior targets.
And to hit those targets?
To hit those subscriber targets, FWA requires rock-solid, high-capacity, and reliable network coverage to compete effectively with cable ISPs. That requires immediate and extensive densification, adding more radios, upgrading power systems, and generally maximizing usage on existing towers, all of which drives leasing revenue for CCI.
Now we have to address the biggest near-term execution risk, which the old transcript glossed over, the debt maturity wall. This $6.9 billion in debt maturities scheduled for 2026 and 2027 is a looming threat, isn't it? Especially with interest rates where they are.
This is the centerpiece of the bear case and why execution needs to be absolutely flawless. CCI has $6.9 billion in debt maturities hitting in those 2 years, and refinancing that debt is non-trivial.
And that's where the sale proceeds come in.
The $6 billion paydown from the fiber sale is critical, but they have to use that cash to deleverage before those maturities hit to minimize the amount they have to refinance at potentially higher rates.
So what happens if they fail to hit their aggressive 6 to 6.5 times leverage target before they enter the negotiation window for those maturities?
The cost of capital jumps significantly. If the credit agencies feel they haven't executed the deleveraging successfully, or if operating cash flow falters, their borrowing costs will rise substantially. That would eat into the very efficiency gains they're trying to achieve through the pure play model.
So even if the strategy's right, bad timing on the financing could sink it.
It could severely hamper it. Given the current interest rate environment, refinancing that $6.9 billion will almost certainly be at a higher coupon rate than the debt it replaces. They need that lower leverage ratio to mitigate the scale of that interest expense hike. This is a massive balance sheet juggling act.
Finally, we need to consider contract stability. Given the pressure on carriers to reduce costs, how protected is CCI from carriers trying to reduce rent or relocate equipment?
CCI maintains strong protection, primarily through their master lease agreements, or MLAs, which are long-term predictable revenue contracts. And crucially, they maintain a firm MLA with the Dish network that runs through 2036 and covers 20,000 towers.
And they expect that contract to be honored.
CCI expects full payment for the entire term of that long-term agreement. That Dish contract provides a significant, reliable revenue floor, insulating them from some of those competitive pressures.
We've covered the pivot, the pain, the promise, and the severe execution risks associated with the balance sheet. Now it's time to synthesize this entire story. When you pull the bull case arguments against the intense bear case worries, how do we weigh the investment case for the new focused crown castle?
The bull case is, it's fundamentally appealing because it simplifies a complex machine into a predictable cash flow generator. The thesis rests on strategic clarity, predictable pure-play cash flow growth driven by powerful, enduring secular demand.
In the world's best wireless market.
Right. And a massive liquidity event facilitating a highly accretive $3 billion share buyback. Management is aiming for an estimated annual AFFO target of somewhere between $2.265 and $2.415 billion for the standalone tower business, which they believe will command a premium valuation.
That's the upside picture, driven by simplification and share count reduction. But the bear case, centered on financial risk, is equally substantial. Where are the execution hurdles that could immediately derail this transition?
The bear case hinges entirely on interest rate risk and operational slippage. First, that high target leverage of 6 to 6.5 times is aggressive for this environment. It means their cash flows will be heavily dedicated to debt service rather than pure expansion.
And the debt wall.
Second, as we detailed, the execution risk related to the $6.9 billion in debt maturities scheduled for 2026 and 2027 is paramount. Any delay in the sale closing, any failure to hit the deleveraging targets, or any unexpected jump in interest rates could dramatically increase their borrowing costs and render the entire simplification strategy far less successful.
And if the execution needs to be flawless, let's talk about the valuation reality check. Is the market already pricing in this anticipated perfection right now?
It absolutely is demanding perfection. CCI currently trades at approximately 22.7 times forward price to AFO.
22.7. And how does that compare to peers?
That is a significant premium compared to its peers, which themselves are premium stocks. American Tower, for instance, trades closer to 18.5 times, and SBA Communications trades closer to 15.2 times.
A 4-point AFO multiple premium over American Tower is huge. That's not a small difference.
It's massive. It means that every bit of promised efficiency gain, every successful debt refinancing, and every organic growth point must be delivered without fail. This valuation leaves virtually no margin for operational or financial error. If they stumble on that debt wall or miss the organic contribution targets, the stock is highly vulnerable to a significant, rapid re-rating downwards.
So the fundamental question remains, can this newly simplified operator, even with powerful secular tailwinds and efficiency gains from the land purchases and debt reduction, generate enough cash flow growth to justify trading at such a substantial premium compared to its already high-quality peers? It's a fascinating test case for the true price of simplicity and focused strategy.
Risk defined, portfolio protected.